Sounds great. Well, thank you, Marty. Very excited to do this panel, and we have a great group on this afternoon on the topic of manager selection. And Marty, you did a great intro there about what we're going to be covering this afternoon. But let me just really quickly give you a quick introduction to our panelists. So we'll start with Danye Wang. She is the managing partner at UniGlobe, who advises Asian families and investing in the U.S. market. Suzanne Kerry, who's Senior Vice President for Celadon Financial, which provides prime brokerage and capital introductions, and she'll give you a little more flavor about what she's doing. Brian Lasher, who's Chief Investment Strategist for CIG Advisors, Capital Advisors, who provides wealth and asset management. Oh, is my video not on? Jeez.
You just
Sorry, people. There we go. Now you can see me. Apologies. Brian Lasher, who's Chief Investment Strategist for CIG Advisors, who provides wealth management and asset management and business advisory services to high net worth individuals, families, and foundations. And then, of course, we have Chip Perkins. Chip is the CEO of Perkins Fund Marketing and managing member of it, and does capital raising. I think over your 20 years of existence, or 25 years, you've raised what, 8 billion?
A little bit under.
A little bit under. Well, I'm going to give you rounded off to be 8. My name is Mark Heil. I'm the institutional sales for Pacific Premier Trust, a division of Pacific Premier Bank. I've been in the alternatives business since the mid-90s. For those of you not familiar with Pacific Premier Trust, we are largely in the self-directed IRA business. So people putting capital into alternative funds for the retirement funds. But we also do private fund custody. We do custody of retirement plans, broker-dealer successor relationships, ESOP transitions, and custodian connect. Now for Chip's favorite part, it is the mandatory disclosure. Being part of a bank, I have to do this, and the information presented here is for educational purposes only and is not intended and may not be relied upon as tax, legal, or investment or other advice. Pacific Premier Trust performs the duties of the custodian and as such does not evaluate, recommend, or endorse any particular investment opportunities. You are advised to consult your professional advisors for specific guidance regarding your investments. Investments are not FDIC insured and are subject to risk of loss. So that is our disclosure. And now we're going to move on to the important part, which is really to have everybody introduce themselves. And Danye, if you would do me the favor and just talk about yourself, your background, give a little color on your firm, that would really be helpful.
Absolutely. Thanks for the introduction, Mark, and Marty. Thank you so much for having me. Always enjoy coming to IvyFON. I'm based in New York, and I guess the easier way to remember my name, Danye, like Kanye with a D, I guess for American folks. But I do a lot of work with Asia. Before I started UniGlobe Capital, which is my cross-border advisory, mainly working with Asian families, I used to spend 9 years with BlackRock in an institutional sales role, primarily working with larger institutional investors, sovereign wealth fund, national pensions, insurance companies alike. So very familiar with asset classes across the board, but from my own perspective, always wanted to get closer to the family office community and wanted to create investment instrument aligning better with their appetite in the alternative space. So as I've been building up UniGlobe Capital for the last couple of years, I still have some legacy GP relationship from China, but in the last year or so and going forward, my primary focus is going to be working with just a handful, 3 to 5 specific, very large Asian families, but none of them have specific presence, on the ground presence in the US. But I'm going to really be the conduit for them to access US, both funds and direct deals. And our primary interest would be in venture and growth equity, selectively private credit as well, in the space of consumer enterprise fintech, and that includes crypto and Web3, because one of the Hong Kong family has a large crypto mining partnership, as well as healthcare. Like, to be honest, from an access perspective, a lot of the Asian investors realized what they lack, especially when it comes to the emerging manager space, because some of the larger and existing players who have decades of track record in their fund 5, 6, 7, it's already like it's not news to anyone anymore. But when it comes to a really capable teams, maybe spin-off firms, or funds that are still at their fund 1, fund 2, fund 3, but really generating unique strategy, or have sector-specific approach, and really that deep industry perspective, mature investment strategy, but maybe an emerging vehicle is kind of the sweet spot of some of the manager selection that I look for. And from these relationships, and also a whole host of relationship with other family offices, we also do direct deals, especially like SPV structures. That's basically the ballpark of what I've been focusing on. Definitely happy to exchange ideas with the rest of the panelists and also the audience.
Yeah, we're looking forward to that. Thank you so much. That was really terrific. Suzanne, would you step up next and give a quick background about Celadon and your role there? And particularly, I think you mentioned yesterday you have a philanthropic arm as well. Would love to hear a little bit more about that.
Thank you, Mark, and thank you, Marty, for having us. And hello to everyone in California. Boy, do we wish we were there. It's about 17 degrees here in beautiful downtown New Jersey. Not exactly the mild climate and beautiful Pacific Ocean of San Francisco. So as Tony Bennett always said, I left my heart, you know where. So hello, everyone in San Francisco. I welcome chatting with you. My name is Suzanne Kerry. I run institutional sales for a prime broker headquartered in Chatham, New Jersey, with offices in New York, Florida, as well as France. We work with a considerable amount of emerging managers. And these are managers that I would say are probably under 100 million of assets under management and are looking for an execution platform for stocks, bonds, cash, options, currency, commodities, whatever is publicly traded in their particular strategy. We also support our managers with cap intro. So we have an enormous focus on meet the manager type breakfast, lunch, and dinners. Zoom calls have been tremendous. And while they're efficient, I will say that the capital allocation side is still getting used to allocating over a Zoom call, but nevertheless, we can talk about that later. But as Mark mentioned, our firm decided to do something about some of the issues that we saw in the marketplace, being people were suffering under COVID, losing jobs, having people in their family die from the virus, et cetera. We were also very aware of the social justice issues in the United States. And so we decided as a team to stop talking about it and do something about it. And in 2021, we formed the Celadon Foundation. It's a 501c3, and what we offer for our money managers is to, as they trade through us, we will take a piece of their commission and give it to the foundation, which gives it to any charity that money manager wishes to donate it to. So as you can see, that allows charities to have a whole new donor base of found money. In a time when, dinner dances have been shut down and a lot of the typical fundraising that has gone on has been curtailed due to COVID. We also work with charities, and charities become what we call our giving partners, meaning that we take those charities, we work with them, and also we get their donors to give them stock as a donation. And we've partnered with a group called overflow.co. I would highly recommend you go to that website and take a look at what they're doing. It's a technology platform, very much like PayPal, Yodlee, as well as Plaid, that connects to permit stock to be transferred on a donation basis from the donor right to the charity. And Celadon manages that. We liquidate it and then wire transfer those assets. So that's what we're up to. And we got a busy year this year. The kickoff of the foundation has been beyond our wildest expectations. We had very modest goals for the foundation, and it's only January, 12th, and we've practically exceeded those expectations already in the first 12 days of the new year. So we're very excited about it. Reach out to me, please. Go to our website. Let's talk philanthropy. Let's talk commission sharing with charities, and let's do something good this year.
Terrific. Brian, I'm going to put you up next. Tell us a little bit about CIG Capital Advisors and the wealth management and business advisory services you provide, and a little bit about your background as well.
Sure. Thanks, Mark. Thanks for having me on the panel, and also thank you to Marty for inviting me. So as Mark mentioned, I'm head of investment strategy and a lead advisor at CIG Capital Advisor. It provides successful entrepreneurs and senior executives with wealth management and business advisory services. I would add we have a non-exclusive focus on medical professionals and their enterprises. So for example, right now I'm working with a gentleman who is a wholesale pharmacy business into nursing homes, and it's a business that he built, and he is now in the process of thinking about freeing up some time and capital to focus on his next love, which is real estate. So who knows, maybe out there buying a real estate company for this gentleman. And along the way, he's got philanthropic interests. So that's just kind of an example of some of the things that we do. We really operate at the intersection to help people successfully navigate business, wealth, and family, really allowing our clients to focus on what's most important to them and for them to be successful. CIG is headquartered in Southfield, Michigan. I actually head up efforts in the tri-state area, and I'm located in Wilton, Connecticut. I've been selecting emerging and regular old mainstream managers since the late 90s across public, private, hedge, and real estate. I think, I guess if it's timely a little bit, Russia's been in the news here with 120,000 plus troops on the border of Ukraine. Well, my first month moving from the world of real estate over to hedge funds was August of 1998. And we had an investment in what then I think still could have been considered an emerging manager that was focused on Russia. So a little bit of baptism by fire. Hopefully we're not, coming full circle here with a lot of problems related to Russia. So that was one of my first manager selection experiences. So you can find out more about us at cigcapitaladvisors.com. And if you're, looking for something to put you to sleep, I do write a monthly little review that you can find under Insights. And, sort of since the beginning of what I mentioned a few minutes ago, I've worked for an insurance company, I've worked for an institutional investment consultant, a private equity firm, and now I've come full circle to work with families again. So that's a little bit about my background.
Sure, that's interesting stuff. And I don't know if you caught the first panel this morning, but they were speaking a lot. It was the economic outlook for 2022, and a lot was on that discussion about Russia and other things going on in the world, and just the general outlook. And we'll be touching on that as we speak a little bit. But first, I want to get Chip in here and let Chip talk about his firm, what they do, and how he fits into this puzzle. So Chip, take it away.
Thank you, Marty. Good afternoon. Thanks for having me back. So we are a placement agent, or as some people would say, a third-party marketer. I've been doing it for 26 years, 25 years as our own firm. We're currently at 6 people, and we are overseen as a broker-dealer by the SEC, FINRA, MSRB, and a couple other people, I think, floating around out there. All of my people are licensed so that they can properly and legally represent the managers that we take on. And we usually take on somewhere between 4 and 7 managers at any given time in non-competing strategies. The biggest fear I have when I wake up in the morning is having this two of a similar strategy and somebody saying to me, so which one's better? Because you can't really do that. You need to have clarity in thought and in purpose of your managers. And I think we've done a very good job in selecting managers over the years. I think that we've been recognized by FINRA for the quality of the work we do on the due diligence of the managers. And we continue to provide information and introduce high quality managers to all sorts of investors, whether they're family offices or institutions, endowments, foundations, pension plans. We do not work with retail investors and don't see that happening in the near future either. That in a nutshell is what we do. Happy to, we're perkinsfundmarketing.com. We're on the web. Take a look at what we do and who we see. Thank you.
So Brian brought up Russia a few minutes ago, and not to say we're going to focus on Russia per se here, but maybe just more of the world state, the state of the world right now, the state of the economy right now. We have, especially when you compare it to the previous 10 years where we had low inflation, steady growth, low interest rates. Now we're in the midst of a pandemic. We've had change of administrations, inflation, supply chains issues, oil and gas. All these things are impacting here. How does that changing, either Chip from your point of view or Brian from your point of view or Danye or Suzanne, any of you can really chime in on this. How does this affect your manager selection process? How does this filter into the evaluation process?
Well, I'll go first just because it's simple for me. I cannot review managers from Russia. I'm not licensed there, so they're out. But we can take on, a varied manager. I can take managers really on that I'm going to sell in the United States from anywhere. But I think that we're driven by what our clients tell us they're looking for, not just today, but out 18 months, 24 months from now. So I don't know necessarily, when we go looking for a manager, we're looking for input from investors. For a while, everybody said, I don't want any more long short, too much long short. There's just too much long short. And there are like 10,000 managers that there were at one time. But now people are interested in that. They're afraid that the market is, in overdrive. And they're concerned that if they don't have a good stock picker, a knowledgeable couple of PMs, in the quiver with appropriate arrows aimed at profits, they're going to get hurt if they just have everything in the market. And there's a lot of different strategies that people are looking at. I mean, people are always looking at real estate. They're looking at real assets. They're looking at certainly credit, but credit hasn't paid off as well as it might have. But we're probably coming to at some point, the stock market will slow down and people will be looking for other avenues. But right now, it's still on everybody's mind.
Brian, you raised the topic. You just heard what Chip said. Why don't you chime in with your thoughts?
Right. I think we got to consider that we're likely in uncharted territory here. And so, this kind of echoes a little bit what Chip said. I think from my own perspective, over the last decade, the Federal Reserve has tried multiple times to end its various money printing programs, but it didn't take very long before a market, downdraft caused a U-turn, right? It'd be like 2018 is probably the most recent example. I think this time the difference is that the perception is that the Fed has lost control of inflation. Certainly today's 7% print may give some additional data point to that. And then earlier this month, on January 5th, the Federal Reserve meeting minutes indicated that officials are considering an earlier timetable for shrinking the $9 trillion balance sheet. So that's not just raising rates or tapering buying, slash printing. That's really taking completely the liquidity punch bowl away. And so in our opinion, the most prudent prescription at this point is some form of active portfolio management. Chip mentioned hedge funds, but anybody that is actively out there trying to pick the areas that are going to be successfully able to navigate whatever comes down the pike is going to be really important. Similar to Chip, our manager selection is all about the clients that we have, and we're basically hearing from them similar concerns about we need good shorters to help us, and insurance. And so as we go out to interview managers, we're really the askers of the questions based upon what I just mentioned our clients are saying. So our clients are concerned that the good times may be ending, and essentially what that means for us, given this uncertainty, I think we need, in addition to process and pedigree, which are important, some clear view of what the current conditions are and a strategic plan to navigate through the known unknowns, the unknown unknowns. You remember that craziness from Rumsfeld. And then they want talented shorters who can manage, potentially some significant stock market weakness. So that may be inside the U.S., maybe outside the U.S. Coming back to your geography question, it's whatever it takes to get us through this uncharted territory.
Right. Suzanne, small and emerging managers, particularly hedge funds managers, have been very creative through the years in terms of finding those niches and areas. What are you seeing from them? What are you hearing from them? And how's the broader economic, geopolitical world affecting them?
It's a great question. Thank you, Mark. If you take a top-down viewpoint, and perhaps some of us would agree that, the British Empire ruled the 19th century, the United States owned pretty much the 20th century, and now we're 22 years into the new century, and we still haven't got a designated leadership group out there. However, it's my opinion that Asia and what Danye is doing in China, et cetera, there's certainly things to be looked at there. Here in the United States, however, to your point, there's been a sea change in terms of what family offices want, what allocators want, what investors want. And part of that change is the focus on ESG and the focus on DEI, which is diversity, equity, and inclusion. The focus on impact, climate change, et cetera, et cetera. And one of the things that we guide money managers on is their expression of their philanthropic outlook, as well as their charitable outlook, as well as their impact outlook. We have tremendous amounts of clients that are very interested in clearly performance. And Chip and I served on a panel just recently for Marty, and Chip said, yeah, come on, Suzanne, if someone's up 40% and someone's up 10%, but the 10% up guy is more philanthropic, guess what? The money's still going to go to the 40%, which I don't disagree with. On the other hand, particularly from the family office market, the succeeding generations are very, very interested in understanding not only philosophy, process, performance, people, but the two new initiatives are really philanthropic, and being able to articulate that charitable outlook and that focus on ESG, DEI, impact, et cetera. So we're trying to advise managers to understand that those questions are going to be asked, and they are more than happy to give their descriptions. I mean, we just opened up a relationship with a high frequency trader, an ESG manager, an impact manager, a long short equity group down in Florida. Hello, shout out to the coconuts. But all these are groups that have got to become a little bit more savvy as to what the due diligence process has turned into, particularly from the family office market that really wants to know an articulated philosophy on philanthropy, charity, ESG, impact, climate change, et cetera. So I think that's a big change that we've seen.
Sure. Have you seen, yeah, I understand that those are some characteristics of funds, but have you seen, more innovative strategies from different folks, people, putting a little bit of a wrinkle on what's been traditional in order to make themselves that much more different? Or are you seeing pretty traditional strategies still coming to the market?
Still seeing typical strategies and traditional strategies coming to the market. But I think that there's a greater awareness. For a while, a lot of money managers were sort of tarred and feathered, if you will, on what they call greenwashing, saying that, we're very interested in the environment and so on and so forth. And yet they don't Exxon or something like that. So it's a bit of a challenge, but I think clarity is coming to this space. And managers really can't ignore it. I think you ignore it at your peril.
Fair enough. Danye, a lot to be taken in here. How do foreign investors looking at the U.S. market, looking at U.S. managers, interpret all this, and how does that, impact what they're telling you, what they're looking for?
Yeah, absolutely. And all of the panelists shared some very good points. From my perspective, so first of all, I grew up in China, so I guess I'm biased, and I know the tricky dynamic between US and China from a political perspective. But from a macro perspective, what I would say is that I'm still a strong believer on long-term growth in China. There are short-term challenges from a capital allocation perspective, especially when it comes to US dollar in private markets, exit strategies. The companies that historically can easily go to New York Stock Exchange or NASDAQ for IPO is now encountering a lot of challenges from a VIE setup or even data security. And Chinese government is cracking down certain sectors, education, real estate, gaming, for example, because they really fundamentally need to change their population structure. My generation, the product of one-child policy, unfortunately, in today's world, caused a huge aging population for China. And from a government policy perspective, they just have to solve that. However, these policies were rolled out in a super concentrated way, and for a lot of investors, both domestically and international LPs, because a lot of the top endowment foundations, pension funds, sovereign wealth fund have been investing in China for the past 10 years. So it's true that people know it's one of the fastest growing countries with tremendous opportunities, but who are you partnering with, and what are the challenges there? And going forward, how money is going to be made in the next 20 years is going to be very different from how money was generated in the last 20 years. So there's a lot of, it's kind of a changing dynamic right now. So I do see in the international LP universe, endowment foundation family offices alike are kind of on hold, but a lot of them still have longer term views, positive views about China. But the trickle down effect is that a lot of investors still look at Asia as a growth market, and as a result of that, a lot of US dollar capital end up going to Southeast Asia, Indonesia, for example. And there have been a couple of really large funds coming out of Southeast Asia because that capital has been a little bit hesitant going directly to China. And because of the decoupling between US and China, I'm actually super positive on the US from venture and growth capital perspective, because I still think from a technology innovation perspective, this is still one of the most fascinating investment destination of the world, because of the talent pipeline, because of certain clusters of innovation and new ideas generation. And so that is on my geographic view, and then asset classes, right? So we're talking about macro dynamics and Fed raising rates for 2022. And I think the biggest impact is going to be on equity markets. Valuations already pretty much at all-time highs, I mean, the last couple of years. So a lot of people are rebalancing their book of public equity and thinking about either fixed income alternatives or select sectors of alternatives where either they make the decision of locking up their capital for the next 5 to 10 years, but they're also looking at solutions, either innovative solution of wrapping venture or growth equity in like a 3-year term or an evergreen structure, or they can basically sacrifice some of the returns, but have kind of a guaranteed layer of their principal, or even taking distributions for some of the private investments. So from my perspective, I've been seeing a lot of innovative setup from a fund structuring perspective.
Yes, 7, you're 25% of the league, and who knows, maybe we'll get.
Must be interesting, Chip.
Okay.
Just came across my phone. I was like, what the hell?
Oh, okay. I
Hey,
thought you were either
that
agreeing
happens,
with
you know.
me or not so much. But anyway, I definitely have seen even from an emerging manager perspective coming up with innovative structure, liquidity, return profile perspective to tailor to certain family office appetite. So I'm pretty excited about that. And the last piece I want to mention about some of the macro dynamics and the impact, especially on Asian family office that I'm very close with, is generational transitions. To be honest, I'm not sure if this is as prevailing in US family offices or multifamily offices set up, but in Asia, a lot of the families that I ended up working with, the owner, they're like the first generation wealth creators, are very interested in really bringing their kids onto the table. So their sons and daughters are typically very involved in making investment decisions as well. So it's been quite interesting from my perspective to kind of bring both of their perspective together.
Yeah.
Hey, Mark, can I just jump in here for 1 second?
Sure.
So, I mean, we heard the first panel of the day, and they're saying that they expect a lot of rate increases. You know, can you guys talk about what's the impact on things like venture? I mean, you know, venture capital has raised so much money, you know, in the last few years, as well as for lending. So like in 2008, when the market crashed, you know, the Fed went on this, you know, zero interest rate lending spree, and it really bailed out a lot of things. I mean, people were able to borrow money, issue secondaries, you know, et cetera. But I mean, is value going to come back in? I mean, value has been wandering in the desert for a long time. So can you guys talk about, you know, what strategies you expect to see come back or to be in vogue in the next year or two as a result of, you know, an expected Fed increase? And obviously, you know, there's a geopolitical volatility as well.
I don't know if it's Chip or Brian wants to field that question first.
I think it's Brian's turn to go first.
It's Brian's. He brought up the whole geopolitical economic area anyway, so it's on
We've
you,
known each
Brian.
other too long. So let's take it sort of lockstep here. I think venture-wise, we've already seen what a small uptick in rates has done to multiples on the NASDAQ here. And so I suspect that you know, valuations for venture capital will come down. I think if you're putting new money towards that is beneficial for you. Second point would be the excess liquidity that's been in the market. Lower rates dampens volatility. You can kind of see this in the VIX. It's been going into a pretty steady wedge, although you know, with lower highs and higher lows. I would say that the VIX itself, an imperfect measure, of course, is still higher than what it had been in the past pre-COVID. So I suspect with volatility being both more variable and higher, that long-short equity is going to pay off as a potential strategy. And then you know, on the lending side, you know, they will be ending their programs, the Fed, and you know, if they raise rates and throw us into a recession, that credit spreads will widen. And so at least on that front, you know, depending on where you are in the scheme of things, you know, who knows, we may actually even get a distressed debt cycle here. But at the same time, there's probably other opportunities as rates move and there's more volatility. So I don't know, Chip, what do you think?
Well, I haven't seen anybody do well in distressed lately because it's been a really tough market.
There hasn't been any.
There hasn't been a distressed market in forever. So there's some great managers out there too, and I hope they have another swing at the ball. But you know, I firmly believe that, you know, venture capital has been a little bit overpriced and have promised some very solid returns. And everybody tells you, oh, you know, I always get 20% with my, you know, venture and my private equity, or 30% or whatever it is. I'm not sure if this time around that's going to happen. I think that there's been way too much money chasing it. And I think that, you know, investors may get a reality check. You know, they're still going to make money. Those guys are brilliant. But I don't think they're going to make the same kind of money. I'm and continue to be a big believer in long short equity, as you just mentioned, Brian. I think that a good stock picker is going to find good opportunities are going to go up and bad companies are going to go down. I don't think it's going to be like, you know, the late 90s or even some of the, you know, the last decade. But I think that there's going to be good opportunity to find good managers and everybody to make a reasonable return. I think that people just need to get out of their heads that, you know, if it's a hedge fund, it should make you 55% every year. That's not going to happen. But you know, I think that's where the most opportunity is going to be, is in smart use of equity investing.
Danye, you mentioned a bias for growth capital and venture capital. Are there particular sectors within that area you think will outperform and do better, and maybe be where you concentrate some of your investments and manager picks?
Interesting question. That is actually not an apple to apple comparison, but I do want to firstly resonate with what Chip commented. Precisely why I'm focused more on providing access to smaller managers, emerging managers, where they can be more disciplined because they probably don't have as much of a dry powder. So they want to make sure every one of their investment count. And if you have a deep pocket, sometimes you would be too aggressive or too overconfident when you go into some outrageous valuations at this point. And my comment about growth equity, it's and people probably know this in the audience, Asian investors from an appetite perspective, they really care about the duration of the investment from a liquidity standpoint. So historically, a lot of them are interested in growth equity investment just because they can expect an exit, say 3 years ahead of time, instead of like 8-10 years of a traditional like early venture. But I think they've gone through enough education and economic cycles to realize if they do enter an investment opportunity at a much later stage, the valuation would already be at very high. So I would say even for growth equity, instead of going at the pre-IPO round, a lot of them are moving a little bit ahead of the curve. Series C, Series D, or sometimes even Series B are considered kind of early growth equity. And when it comes to venture, as I mentioned initially, consumer, enterprise, fintech, including crypto, Web3, as well as healthcare, are some of the verticals I spend a lot of time on. And I would say I have more of a bottom-up approach in the sense that I want to make sure it is the right team executing the right strategy, and they really know from an industry perspective what they're doing, and they have a specific or some sort of a differentiated approach. And sometimes it's a smaller venture firm, but they will make sure they have a seat on the table because they can bring in resources some of the larger managers simply don't have, and they can actually bring in more influence. So instead of, I guess, comparing different sectors, it's more like just making sure I'm finding the right managers in each specific sector. I will say that, last comment, Asian family offices is in the process of finally approaching their allocation in the true sense of diversification. Previously, if it's a real estate company, they want to bet more on real estate. If it's a consumer company, they want to do more in consumer. But now they finally realize it's really important. If they are traditionally a healthcare company, it's important to do generic public equity, maybe hedge fund. It's important to still have a well-rounded approach to alternatives, real estate, private credit, and different sectors outside of what they're typically familiar with. So I've seen a more holistic approach from a sector allocation perspective. But again, I want to make sure that I find the right players in each sector vertical.
Sure. Suzanne, you've heard a lot about discussion here about long short equity managers coming back into favor. Are there other strategies you're seeing or hearing or believing that will also follow suit?
Yeah, I'm seeing a lot of thematic approaches, and that can be a subset in the long short sector. A thematic approach being, say, for example, the future of electric cars, and therefore the enterprises are going to have to support that effort, batteries and so on and so forth. That could be identifying leaders within that theme, and then having the short book either with the weak sisters or those that are going to lose market share because of the leadership on the long side. So we see a thematic approach, and healthcare is also a continuing theme. Healthcare has been very, very strong in these last a couple of decades for managers. Technology, my goodness, but with the Fed's tinkering right now, you can see that the tech sector is selling off a bit because of that. And, I think back to the days when I first got in the business, and I won't tell you what year that was because that's nobody's business. But when I first got in the business, one of the first things we sold were electric utility bonds at 16 5/8% coupon.
Well, now you've dated yourself.
I know, right? And I can remember an elderly gentleman who was wonderful. He was part of the DuPont pension fund. He said, "I'll take whatever you guys got." And I said, "Really?" I said, "Jesus, you've just made my day," because they were taking, a pretty big allocation. And he said, "Let me tell you something there, young lady. You're never going to see rates like that on bonds ever again. So whenever they come along, these are the moments where you have to get on board." So I think what I'm trying to answer your question with, Mark, is that it takes a little experience and it takes a little perspective as to what are all the data points out there and what are they leading us to, and what are those data points going to produce, and where will the opportunities be because of those data points. So I don't think you can ignore what the Fed is doing, and I certainly don't think you can ignore different sectors of the market. But a thematic approach is something I'm seeing that's a little bit more interesting to me on the long short side.
Let me ask you a question, because you see a lot of small and emerging managers. Some of them spin out of larger shops.
Yep.
And as you know, there's a lot of people that are great analysts or write the great reports or do the wonderful research, but it doesn't really translate into great pickers when they're the ones sitting in the hot seat. How do you test for that with your small and emerging managers? How does that impact how you diligence, look at the whole process for them?
You're absolutely right. And
I should
my goodness,
really give that credit to Brian. That was his question, but I figured you were the perfect one to ask it to. We'll go back to Brian, make him answer it too.
Yeah, well, many people, when they hear the term emerging managers, they always have this vision in their mind of two guys and a card table. And that's certainly not the case, because we've had emerging managers that have lifted out of Celadon and big shops and have run their own show very successfully. But you're right, Mark, the ability not only to analyze the market, but the ability to be timing that market and the ability to run that business are the three legs of that stool. There's no question about it. And I've talked with a lot of money managers that are a little bit, shall we say, rose-colored glasses, to think that their prime broker and everybody else is just going to say, great, oh my goodness, let's give you some money. It takes quite a bit to establish yourself in the emerging manager world, but I think that the opportunities are there. We see countless emerging managers that are long short in the biotech space and sectors and so on and so forth. The option trading has been quite significant in these last couple of years because of the low entry price of getting involved in option trading. And we're seeing a lot in the high frequency trading as well. The special situation guys out there are finding it a little bit challenging because many times special situations are being lumped in with aberrations in the market like GameStop and all the other hoopla that's out there that the disruptors like Robinhood have caused in the marketplace. So the market will settle down ultimately, and I think there's still tremendous opportunity for those that can not only analyze the markets, but also time the markets in terms of their entry point and when stocks are priced to perfection. And also the ability to run a business. Huge three legs of that stool.
Fantastic. Brian, some additional thoughts on that? I'm sure you put a lot of time and effort into this question, and be interested in hearing your thoughts.
Yeah, so I guess it's just to jump off from where Suzanne was talking about, I think timing and luck is an important part of coming out at the right time. I don't want to downgrade that at all, but I would say that essentially what we're looking for is PhDs, pretty hungry, driven investors who come out of a good shop. Sometimes it's teams, and they want to be incredibly successful. Sure, as Suzanne said, there's guys who come out of Citadel, gals who come out of some tiger shop, and it's a billion or two of AUM out of the gate, even in the past sometimes. So, but that denotes some level of success and comfort that doesn't always work for folks like myself. It doesn't sound like it works for Danye either and her clients. So the one area that I would focus on, though, is really when we work with entrepreneurs, our strategy efforts with them are all about, a complexity, challenge, and compromise to be able to wind their way through the analyzing the market, the timing, and everything else. And for the manager to be able to spend 100% of his or her brain share on that, they really need a dedicated CFO to help them solve some of the inevitable issues that come up as they build what I think, apropos to the comments about, quantitative businesses. It's an incredibly and increasingly complex business where money's not unlimited. So I would say what you really need to do is have a 3-year plan with 3 years of resources, be a little bit lucky. And I think that's incredibly important to long-term success, and then being flexible along the way to whatever, comes down to the pike, so to speak, at you.
Fantastic. Chip and Danye, we have a question here that came in. Any views on emerging managers from emerging markets? So, Danye, I'll let you lead off here, but then I want to get Chip's, and then I think after that, Marty, we'll have one final question. We'll let everybody it'll be a quick hitter and wrap it up at that point.
I guess there's different definition when it comes to emerging managers, as we already discussed about, and also different definition on emerging market. For some people, emerging market is like MSCI equity and emerging market definition, and some other people it means Southeast Asia or Latin America, or some people refer to China still as emerging market. So in general, I look at them, but again, my standard of emerging manager definition is mature investment strategy, mature investment experiences, or even teams that they used to work together in a previous shop, but it could be a newer investment vehicle or firm. So I guess that's my definition of emerging manager. It doesn't apply to AUM specifically. I rather work with smaller managers where the families I bring to the table can actually have an influence and maybe some sort of a strategic partnership. But I do care a lot about the quality of the managers, and it's not just about where you graduate from school, the typical pedigree, but really about if you are the right team to execute on the strategies that you want to deliver. Oh, sorry, said I mean Africa. I think there's tremendous growth there. I personally haven't done as much. I do know a couple of like former colleagues, former classmates that are from that origin that have since launched funds. I haven't got a chance to participate myself. Maybe Chip has additional insight here.
Hey guys, can I just jump in for 1 second, Chip? Can you also address capacity, limited capacity versus, larger capacity in strategies? Thanks.
In Africa, the capacity is probably limited, but I think that Africa's tough. It's hard enough to get people to go to Asia, and lately, of course, you really can't go anywhere. I've met a few guys from Africa. I think there's a lot of opportunity there. I don't think that, again, the public markets are that large. So depending on what the strategy is, mineral and mining is always interesting there. I think that real estate will get interesting again. And if you're looking at Africa from, Egypt to the Cape, it's there's a lot of opportunity. And I think that what you have to do is not forget what you use wherever you are in the world when you're looking at an emerging manager. Process, pedigree, performance, and team. You've got to know these people have, they got a process that they can stand behind. It's not going to change. They've got pedigree. They've done something somewhere important. They have performance, because I don't care what anybody says about anything philanthropically or ESG or whatever it is. Without performance, an emerging manager is really going to stumble and have a very difficult time. And then you got to be able to have invested enough to have a good team. As Suzanne mentioned, it's no longer a Bloomberg in the garage on a card table. Really can't do that. You need to have, maybe a COO, maybe a CFO, whatever. You need to have some semblance of a team that you can then point to as, this is how I'm going to do the process. And this is our pedigree. And, we're therefore going to generate the performance. So that's.
If
And
I
Mark,
could just
I can
compliment
jump
in on that.
one
Go on.
last comment, Mark. To Chip's point, we're seeing an enormous demand from the emerging manager side for outsourced CIO services. And Celadon provides an outsourced CIO service. So that's a way for an emerging manager to really start to spread out their capacity, et cetera, et cetera. Just want to make that point.
No, that's great. I'm glad you did. Thank you.
I want to just, sorry, two quick comments. I think we really need to think about, on behalf of the families we work with, or on behalf of the emerging managers that maybe Chip and Suzanne represent, how do you actually conduct due diligence? Like this gentleman asked about emerging manager in Africa, and some of my challenge is that the Asian families can't right now come to the US to conduct due diligence. So they have to have someone they really trust, or they kind of already know the sector really well, or they know someone who knows the management team of the newer manager. They got to be some sort of a connectivity to give them the level of comfort to really pull the trigger. So the due diligence process is getting more challenging around the world, just given prolonged COVID. But I guess we have to take that into consideration, because we're all competing for shelf life, and all the allocators, like if they can make a simpler decision, easier decision on something that is easier to conduct due diligence on, they will, because they will give them the level of confidence they look for. And if it's too hard to conduct due diligence, they probably will have to pass.
Sure. And I'll throw in one little comment here. Just I've noticed that a lot of impact investors, when they're investing in emerging markets, use a debt strategy because the exit markets for equity strategies are limited. And that certainly plays into the factors of how they look at the market and play in those things. Other things that come in is certainly you have REDD plus credits that can be sold off to companies that factor into revenues and things of that nature. So there are ways of generating incomes for these businesses other than just the straight sales of their products or exchange. And of course, you know, Marty's always on banking the unbankable. That's another thing that impacts these things. But I think we have to wrap up here. So I just
Mark,
want
I
to
just
ask
have one,
everybody.
Mark, I have one quick question. It's a
Sure.
30, it's a 30
It's your
second-
show, so absolutely.
Yeah, 30-second answer from each one of the respondents. So I'm just looking to see, you know, what their thoughts. So, you know, one of the things from being in the hedge fund space for forever is that a lot of the hedge funds don't succeed year after year. Many funds don't. You know, it's a certain type of venture capital fund that has, you know, multiple vintages, right? So what kind of return hurdle do you guys look at for a manager to be successful? Because, you know, assuming that they may have one great year and then have plenty of not so great years. So, you know, any thoughts on that? But please, let's be brief so we can get on the will.
I'll go ahead. I think that for me to be able to bring somebody to investors, even if they are a pension fund that has a hurdle of 8%, I've got to be certainly in the or the opportunity to be in mid-teens, you know, 13 to 17 kind of thing, where people won't even look at it because they've got a lot of managers in their portfolio. It's not like I'm bringing them their first hedge fund, right? They've been doing this for a while. And therefore, you know, to replace somebody that they're already comfortable with or working with, you got to have some performance to show them in addition to the team, in addition to the pedigree, in addition to, or they just won't, they won't give you the time of day. It's just the way it is. They'll be polite. Like Brian's always polite, but you know, I gotta come with something that's worthwhile, or people are like, you know, I can't come with 7 unless it's a specific product.
Can we move on to the next person? And what's their answer as well? Danye.
Danye, you want to pick up here?
I'm sorry, I actually missed the question. Sorry.
Is there a return hurdle? Because, you know, we've had lots of hedge funds who did great one year and not so great the next year. VC firms, you know, the problem with VC firms is that they focus on like an area and then everybody else jumps into it. It was like that year, was it 4 years ago when there was like, or 5 years ago, when 200 crypto hedge funds started. So like the ones who were in the year before that, they did phenomenal. You know, they had like 1,000% returns or 100x returns. And then the next year crypto crashed, but they had launched 200 hedge funds and every one of them, you know, crashed and burned. So any thoughts on return hurdles?
Yeah, so the performance in venture world can be vintage year specific. I get that. My challenge with hedge fund is that, yeah, to your point, it's challenging to have consistent performances, which is why actually one of the family I work with, they're kind of desperate to get into managers like Sequoia, not because of the return they're able to deliver, but more about the downside protection. So at least they can expect something very consistent. So it's, at least in front of them, sometimes it's harder to articulate the advantages of an emerging hedge fund. But when it comes to more stable return or return hurdles, I've seen some emerging venture managers giving a hurdle of 8%. I've even seen 12% for first fund, which is kind of crazy for venture fund, but they're able to pull it off. And obviously there's a lot of private credit, direct lending, or fixed income alternative type of strategies that maybe give you like a 2-3 year lockup. but then offer like 8 to 12% or sometimes even more aggressive than that. Yeah, so I think Asian investors, of course, they don't want to lose money. So my job is to diversify it enough to make sure my baseline is covered. But yeah, because Asian markets have returned so well in the past 20, 30 years, they're still barbelling. So at least they still have hopes for some of their allocations that can generate really, really good returns.
Ryan, do you have any thoughts on minimum returns for you, or hurdle rates, or whatever you want to term this?
Sure. I guess I'll be a little bit less polite than my reputation and just say that I would never underestimate the ability of a committee making a decision to chase returns and to avoid strategies that have not done well. And in that case, Chip's spot on. You need double digits, to make something happen. But if you really want to add value for your clients, I think that you really need to assess the manager's returns, given the current situations, conditions and everything else. I mean, I'll give you an example. I was an anchor investor in restarting Contrarian's emerging markets debt fund in 2009. In 2008, in the teeth of the great financial crisis, their EMF fund lost 30%. And most of their clients on the institutional side, luckily the retail, sort of high net worth and folks stayed around. If you want to add value, you have to go through some serious due diligence to overcome the fact that someone was down that much, and consider the scenarios for things turning around. And we did it, and my clients enjoyed generous returns for the next 7 years.